If you're new to investing and want to build long-term wealth the simple way, then today's video is for you, as we'll be breaking down some of the best buy and hold ETFs designed for steady, reliable growth over time, and they happen to be ones that I've personally been holding for years in my own portfolios. Now, with hundreds of ETFs trading on the TSX and CBOE, the best option really comes down to your goals, time horizon, and risk tolerance. But today we'll be focusing on broad market, lower cost equity ETFs that I believe create great long-term foundations to pretty much any portfolio. All right, so the first ETF that I want to talk about is the Vanguard S&P 500 Index ETF, ticker symbol VFV, which is essentially the Canadian version of the VOO ETF that many investors in the United States are quite familiar with. Now, an S&P 500 index fund tracks the performance of the S&P 500, which represents 500 of the largest publicly traded companies in the United States. And by investing in an ETF like VFV, you're getting that broad exposure to the American stock market as a whole, meaning you don't have to bet on a single company to perform well. Personally, I like VFV because it's really a set and forget position with a very low expense ratio compared to some similar actively managed funds. It isn't trying to beat the market, it simply mirrors it. And this means that you're capturing the overall growth of the American economy, benefiting from US innovation, corporate earnings, and long-term market expansion. One thing to note though is VFV is an unhedged position, which means that your returns are going to be affected by both the performance of the S&P 500, but also the USD to Canadian dollar exchange rate. So if the Canadian dollar weakens against the US dollar, your returns actually improve in Canadian terms. But if the Canadian dollar strengthens, it can slightly reduce your gains. For example, since the Canadian dollar has been underperforming the US dollar over the past couple of years, VFV investors have actually seen a boost to their returns, as the stronger US dollar has amplified gains when converted back to Canadian currency. And do note though that this currency effect can swing both ways. Over the long term though, it tends to balance out. Now, VFV is offered by Vanguard with an incredibly low management expense ratio of just 0.09%. This means that for every $1,000 that you have invested in this ETF, you'd only be paying about 90 cents per year in fees. Now, over the past decade, VFV has delivered annualized returns of roughly 15.5%, which is very impressive for a passive ETF requiring virtually no effort or management. This is a great ETF to hold in pretty much any investment portfolio or account. I personally hold it in both my non-registered corporate accounts as well as in my tax-free savings account. It's just a great overall position at a low fee to get some long-term growth, and that is going to also return small dividend amounts every year. Hey, quick break to speak about today's video sponsor, Moomoo, one of the most powerful investing platforms that I have used here in Canada, especially if you trade US ETFs from Canada. Now, here's something most people don't realize. Currency conversion fees are one of the biggest hidden costs for Canadians that are buying US investments. If, for example, you invest $5,000 through another competing platform, you would pay about $75 in FX fees at the 1.5% rate, or wait days for Norbert's Gambit to process. But with Moomoo, there are zero conversion fees, and your funds exchange instantly between Canadian and US dollars. That alone can save you a ton of time if you buy US stocks or ETFs regularly. Beyond that, Moomoo's ETF research tools are really top tier. You can screen and compare hundreds of ETFs by performance, yield, or even sector, and each page gives you deep insight into top holdings, portfolio breakdowns, assets under management, as well as dividends, all in one place. It's basically like having Morningstar and a trading terminal combined, but for free directly in the Moomoo app. And currently, their welcome bonus for new accounts is insane. Deposit just 100 Canadian dollars and you'll get $50 cash back. That's an instant 50% return. If you deposit $5,000, you'll get $300 cash back plus up to 60 days of commission-free commission-free trading, which can save you up to $2,000 in fees. Plus, you can earn 6% interest on your first $10,000 in a cash account for 60 days. And if you transfer investments from another brokerage to Moomoo, there's up to $2,300 in additional cashback available. So if you're in Canada and you want to save on FX, get pro-level research tools, and grab some huge sign-up bonuses, check out Moomoo using the top link down below in this video's description and pinned comment to get started today. So the next ETF that I want to talk about has the ticker symbol HXQ, and this is the Global X NASDAQ 100 Index ETF. As the name suggests, this fund tracks the NASDAQ 100, which includes the largest non-financial US companies that are listed on the NASDAQ stock exchange, primarily major players in technology, communications, and consumer services. Now, the reason why you'd want to consider HXQ is because of its impressive long-term growth potential and strong historical performance. Since it's heavily tilted towards tech and innovation, well, it does come with slightly more ups and downs, right? Volatility, but it also means exposure to some of the world's biggest and most influential tech companies located in America, like Nvidia, Microsoft, Apple, Amazon, and many more. Now, compared to the broader S&P 500 index, though, HXQ is much more concentrated with a handful of mega cap names that do drive most of the performance. That concentration can be both a strength, but also a risk. On one hand, you're gaining exposure to, again, some of those most innovative, fast-growing businesses in the world, but on the other hand, you're tying your results closely to the tech sector's volatility. Still, if you're confident in the long-term growth of technology and digital infrastructure, which I am, HXQ is a very solid buy and hold ETF to consider. Another thing to note is that HXQ typically pays very little to no regular dividends, since most of its returns do come from price appreciation rather than income distributions. So while you won't see frequent payouts, that makes it ideal if your focus is really on growth over cash flow. And with 5-year annualized returns of around 18%, it is a strong performer, though of course past performance will not guarantee any future results. When it comes to fitting HXQ into your broader portfolio, though, I would personally use it as a smaller position on top of a core S&P 500 investment, or if you do want heavier exposure to that tech sector, you could increase your weighting slightly towards HXQ. Next up, we've got XIU, the iShares S&P TSX 60 Index ETF. That is a mouthful. Basically, though, the classic Canadian ETF. This one gives you broad, low-cost exposure to 60 of Canada's largest and most established companies, covering a mix of sectors like banking, energy, telecom, railways, and even utilities. So for anyone who's looking to invest heavily in the Canadian market, this is really one of the most straightforward ways to do it. Over the long term, XIU is a simple, highly liquid ETF that gives you access to a basket of blue chip Canadian stocks and companies that have been around for decades, consistently generating profits and paying out reliable dividends. That makes it a strong choice if you're looking for a balance between income and growth. That said, there are a few things to keep in mind, of course, before going all in on XIU or taking a small position in it. The Canadian stock market is heavily concentrated towards financials and energy, meaning major banks and oil producers do make up a large portion of the index. So you won't see much exposure to tech or high growth innovation here. Save the exposure, of course, to Shopify that's been a return leader for the fund. You'll also notice some overlap if you already hold other Canadian dividend focused ETFs, since many of the top holdings are going to be the same. There aren't that many companies listed on the Toronto Stock Exchange. Now, when it comes to fitting XIU into your overall portfolio, it is a great home-based ETF that can complement US and international equity positions quite nicely. It comes with a relatively low management expense ratio of 0.18%, pays out quarterly eligible dividends, and has delivered annualized returns of roughly 14.75% over the past 5 years and 10.88% over the past 10 years, which is quite solid for such a hands-off investment as well. All right, the next ETF I'd recommend looking into for long-term growth is VDY, the Vanguard FTSE Canadian High Dividend Yield Index ETF. In simple terms, it's built around Canadian big banks, energy companies, and telecom giants. Basically, steady dividend-paying blue chip stocks. Companies like Bell, TELUS, TD Bank, Royal Bank of Canada, and so forth. Now, what sets VDY apart from the others we've talked about in this video is that it is income-focused, meaning it's designed to generate regular monthly cash flow that you can either reinvest into your portfolio or use as income. Plus, since these are Canadian eligible dividends, they're taxed more favorably than regular income, a nice bonus for taxable accounts. From a long-term perspective, VDY is a great addition for stability and consistent cash generation. That said, keep in mind that it's heavily focused in a few key sectors, mostly financials and energy. So while you're getting dependable payouts, you're also taking on some extra exposure risk to those areas of the market specifically. Now, if you already own something like XIU, the ETF we just covered, you will likely see a lot of overlap. So it's definitely worth being cautious about doubling up too much. And like most Vanguard ETFs, VDY costs are very low, with a management expense ratio of about 0.22%, which is quite reasonable for a dividend-focused fund, actually. And over the past few years, it's delivered 5-year annualized returns of around 17.6%, which is amazing, and 10-year returns of around 11.5%, making it a very strong performer for a fund centered around stability and dividends. And finally, let's talk about VGROW, the Vanguard Growth ETF portfolio. This one's basically Vanguard's all-in-one solution for investors who want a very hands-off, globally diversified portfolio without the need to buy or manage multiple individual ETFs. It's really a one ETF portfolio position made up of roughly 80% equities and 20% fixed income. So you're getting strong long-term growth potential with a built-in layer of stability all inside one single position. Now, what I really like about VGROW is that you don't have to worry about ever rebalancing or choosing fund weight yourself. Vanguard takes care of that automatically, adjusting the mix of stocks and bonds to maintain that target allocation. So if you're someone who really just wants to set it, forget it, and let your money grow, this is a great option. One of VGROW's biggest strengths is its diversification. You're not just getting US or Canadian exposure, but also international and emerging markets along with global bonds. So in total, you're getting access to thousands of individual positions across multiple sectors and regions of the world, which makes it a very balanced and resilient portfolio option. So even though all of the ETFs we've spoken about in today's video are quite passive, an ETF like VGROW, which is a portfolio ETF, is what you consider fully automated. No rebalancing, no micromanaging required. In the slightest, you can just dollar cost average into it every single paycheck. And now with a management expense ratio of around 0.25%, it covers all of the underlying funds and that built-in rebalancing service. Over the past 5 years, VGROW has delivered annualized returns of about 10.6%, which is a very solid performance given the level of diversification and ease of use. In my opinion, VGROW is one of the simplest and most effective ways to build a long-term diversified portfolio with minimal to zero effort. Just a quick note though, if you're already holding other Vanguard ETFs like VIV or XIU, that's an iShare ETF, but the point being, there will be some overlap inside VGROW since it holds some of the same underlying funds. That's not necessarily a bad thing though, but it is worth checking and considering before doubling up. And as a general rule of thumb, you really don't need to own every ETF that we've mentioned today. Many of them do overlap, and even just dollar cost averaging into a single S&P 500 ETF can be a great first and simple way to start building long-term wealth. There's no need to overcomplicate things. Okay, so the truth is, investing really doesn't need to be complicated at all. In fact, the best portfolio is usually the simplest one that you'll actually just stick with. If you just want the straightforward, growth-focused setup, something like VFV really gives you great exposure to some of the best companies in the United States for the long-term growth and expansion of the US market. And if that's what's going to really just get you to start investing and sticking to that plan, then great, that is a win. If you enjoyed today's video, please take a second to drop a like. It really helps my channel out. And if you do want to dive a little bit deeper into DIY stock market investing, I'd highly recommend you check out my 100% free to watch stock market investing course. It's over on Skillshare, has over 7 hours of content and over 3,000 students. You can check that out again using the link down below. It is free on a 1-month free trial. So thanks a lot for watching. And as always, I'll see you guys in the next one.